I cannot be more excited for this because there are two important things happening. Crimes being covered up on Wall Street and the SEC in the center of it. Are SEC protocols, new rules and regulations about shorts reporting going to be able to cause meme stock style volatility, leading to a situation similar to GameStop market event, and SEC's proposals allowing other traders to front run or short squeeze hedge funds that wanted to bet against a company's stock? Let's take a look in this video. I'm going to go all the way to the end to make sure that you guys get the information front loaded, and I'm going to talk about what I expect for Tuesday. So you guys make sure slapping that like is the best way to get this message out before that Tuesday market reopens. How's it going, guys? That sleepy dog over there is Meatball. My name is Andrew, and we are talking directly to you at home. Let's talk about what these proposals are, why they're so misguided according to hedge funds right now, and exactly what is this report going to say about potential squeeze climate. Let's talk about what's on the menu. First things first, we are looking at Credit Suisse chairman facing upheaval. He's gone. He's out of here. Credit Suisse will stick to its strategic overhaul despite the abrupt departure of its mastermind Antonio Horta Osorio following an internal probe into his personal conduct. So, Credit Suisse getting a chop right at the most crucial part, because we are looking at hedge funds having trouble sticking together, getting their stories straight. Gary Gensler, the SEC chair, said in November that it was time to bring securities lending out of the dark. The SEC has proposed extensive reforms to securities lending arrangements, which allow hedge funds to pay a fee to borrow stocks and bonds in order to bet that an asset will fall in value. The process is known as short selling. Lenders and lending's agents will together pay about $375 million in initial costs and $140 million annually thereafter to comply with the proposed reporting requirements, according to the SEC. But the drastic changes in reporting and disclosure standards planned by the SEC have triggered opposition from hedge funds and other key players in securities lending, including BlackRock, the world's largest asset manager. Jennifer Hahn, head of regulatory affairs at Managed Funds Association, the Washington-based trade body that represents hedge fund managers, said the SEC's proposal were misguided and could create more meme stock style volatility, leading to situations similar to GameStop market event. So we're looking at, directly from the horse's mouth, a GameStop market event on the horizon if this SEC proposal goes through. Hahn said that the MFA was strongly concerned that the other market participants would be able to reconstruct or reverse engineer a hedge fund's trading strategy if the SEC insisted on highly detailed reporting of securities lending transactions. Imagine a fair and free market where you could reverse engineer success if we started telling the truth and becoming transparent with our trades. Oh, you are worried that we're doing illegal actions? If you take a magnifying glass to our actions, you might just find out how we're making all this money and whether or not it's actually legal. Sounds to me like, hey, don't look and you won't find what you're looking for. Right now, we're looking at hedge funds pleading, begging the SEC not to implement this strategy, this new regulation that then allows for, personally, my opinion, a January type event to come back. Gamma squeezing a potential cataclysmic event for hedge funds. They're just going to be upset. And right now, as they are going through Twitter, we are going to blast through a Suzanne Trimbath tweet. If you're a true investor shareholder who cares about their ownership stake in a company, it is not too early to start planning for the 2022 proxy season. SEC rules any shareholder who owns more than $2,000 in a company stock to initiate a shareholder proposal. So not just AMC or GME, right? You could do this because you own the stock and you probably like the stock too. So you want to say in being able to participate. So if you guys want to be able to learn more, go ahead and follow Suzanne Trimbath as well as Andrew Mo Money on Instagram and Twitter so that we can talk off stream. Okay, back to what exactly SEC is planning. Similar objections were voiced by Alternative Investment Management Association, the London-based trade body that represents hedge funds and private credit managers with combined assets of more than $2 trillion The SEC's proposals would allow traders to front-run or short-squeeze hedge funds that wanted to bet against a company's stock, said Jerry Kroll, head of government and regulatory affairs at IMA. Several hedge fund managers said that they saw little upside in talking about their short positions in the current environment. Of course, there's little upside for them. David Einhorn, founder of Greenlight Capital, made big bets against Tesla and Lehman Brothers, has sharply curtailed his public discussions around his short positions. But Carson Block, the founder of Muddy Waters Research, said the new reporting requirements would benefit all market participants by making it easier to gauge skepticism about a company and its propensity to be driven upward in a short squeeze, GameStop being the modern day poster child, making it easier to understand when a stock is going to short squeeze. I'm just gonna let that sink in for a little bit. Meatball, that's exactly the right attitude. We've been waiting to get these signals, the right data, to be able to predict and prevent any hedge funds from losing their heads, right? We don't want it to get messy. We don't want them to be over their heads, even though we know they already are. Demand from hedge funds pushed the cost of borrowing GameStop shares to more than 100% during the second quarter of 2020, an exceptionally high level. By contrast, average lending fees on other U.S. securities were around 1.5% at the time. Revenues from lending GameStop shares reached about $121 million over the 18 months ending June 30th, according to the data provider IHS Markit. The SEC said that the high cost required to borrow GameStop shares could have constrained short sellers and contributed to a price bubble. Many ordinary investors also lost out when the GameStop bubble popped and the value of the retailers' shares collapsed from an intraday high of $483 in late January 2021 to $40 by mid-February. Speculators are not the only ones harmed when a bubble collapses. There is collateral damage to innocent bystanders, including buy and hold retirement investors and index funds. That's right. People got hurt, seriously hurt their retirement funds based on the hedge funds investments in their stead. They ended up losing because of this risky bet. Be very, very careful that you are not acting as maliciously as the hedge funds are in this situation, right? Investors like the stock. That's it. Hedge funds are making money hand over fist. We're talking about trillions of dollars at the expense of the rest of the market. One of the SEC's most contentious proposals is that all lenders of securities should be required to provide details of their transactions within 15 minutes to a central regulatory body, says FINRA, which will publish some of the data. Here is some. Securities lending revenues by asset class. U.S. equity leads far and away the second and third place by double. Asia equity and government bonds are second and third respectively. As well, at the very bottom, corporate bonds and ETFs. BlackRock, which earned $555 million, $500 million from securities lending last year, said intraday reporting would provide low informational value to the SEC while imposing significant additional costs on lenders. Wow. So if you're lending stocks, if you're lending out just like a $500 million profit on BlackRock, you sure don't want to have low informational value. BlackRock wants the deadline for reporting to be shifted to the close of the following trading day. Okay, we can't have same day information. That's not how the speed of light works. Come on now. Better Markets, a Washington-based think tank, warned that the high-speed traders would be able to exploit the delay in reporting transactions and said shortening the delay would be eminently feasible without adding a significant cost. So, seems like it's very well in the realm of possibility. Stephen Hall, legal director at Better Markets, urged the SEC not to dilute its proposal. Stay clean and clear. Do not dilute your proposal. The financial industry often seeks to weaken or eliminate regulations by arguing that the requirements will have a devastating impact on their business, which will in turn harm the public interest. These kind of claims are typically exaggerated, if not entirely groundless. Hurts us means it will hurt someone else. Basically, a threat. Think about that next time someone says, hey, that proposal, lawmaker, is really going to hurt our business. And it would be a shame if something happened to the small business across the street. IHS Markit reported the average daily value of U.S. equities on loan at $540 billion in the first half of 2021 compared to $428 billion for the whole of the previous year. This created a revenue pool worth $1.9 billion in the first half of last year and $3.3 billion over the whole of 2020. According to the SEC, the value of all securities on loan in the US stood about $1.5 trillion at the end of September 2020. The data are, however, both incomplete and unavailable to the general public, which means this is one step in the right direction. All right, Gary, let's see exactly if you have been doing work in the back end. If you guys want to see me do work in the back end and take a look at the data that we have here, we once again make sure if you guys found this interesting, slap that like to get this message out to as many possible retail investors and apes as possible. And then, most importantly, if you guys enjoyed that, hit that subscribe, hit that join button to join all of these Patreons who make this show possible. Hey, make sure to slap that 20% off button for Lux algorithm. It gives the buy and sell signals to make your day trading easier or your long-term investment plan a little bit well guided. And finally, make sure to look at crypto.com for a link to be able to invest in your crypto needs, especially since this crypto dump has not ended. Ethereum down 3.5%, 4% today alone. Markets are closed, by the way, in America. Doge down about 2.5%, Bitcoin down 2%, but still a fantastic time to be able to get a significant amount invested. BlockFi also will be able to host your needs, and it's a great savings account alternative, all of which are in the links in the description. And we'll see all of you in the money. Peace.